David, your word of the day today, it's jittery. Who's jittery?
The market is basically jittery. You just had a 25% plus run off the bottom. And at this point, you've got a number of good things going on and a number of concerns. The Fed Powell being fired yesterday concern, the ongoing tariff battle concern. So basically, you have a market that's very skittish. On any given day, you could see a few hundred-point sell-off. Yesterday, you saw that sell-off, and then a recovery when the negative news does not seem to be playing out right now.
I want to tell you about the tech trade. We've seen a bit of a roller coaster ride. Tech went up when NVIDIA got the right from the U.S. government to sell its H20 shares, went down on the back of ASML. Now it's back up again on the back of TSM earnings. What's your view of the chip sector broadly and just the tech trade?
Well, that highlights the jittery also. People just don't know what's going on with the fundamentals. In terms of the tech trade, we've liked technology after the sharp sell-off. We thought it would be due for a sharp rebound. At this point, you've got a lot of that rebound. So we think you want to diversify more. We would not be jumping into the tech trade right here. You want to be focused on the broader market, lots of different industries out there, lots of different companies. We'd focus on really good companies that are laggards rather than chasing the leaders.
All right, so to your point, you are kind of getting into the tech trade. Your pick for us today is Fiserv. We're going to show the chart. Now, this stock is pretty interesting. It's a stock that did not recover in April after the low. It's down just year to date. Why is this a company that you're seeing opportunity in?
Well, that's a hideous chart. So we have owned Fiserv for a number of years. We actually sold it earlier this year in the 220 level when we thought it was fairly valued. They had some short-term setbacks we do think are transitory. And at the $166 level, you're getting a very good business that we liked at 220, but you're getting it at 166 at about 16.5 times earnings. We think they have a good long-term growth story, but you're not paying too much for it. In some of the technology stocks, and we do own a lot of technology stocks, but in terms of new money, we like to buy reasonable valuations. In some of the technology stocks, you're paying 30 and 40 times earnings. In this case, you get a company with good long-term prospects, but you're not paying too much.
At a JPM conference a couple months ago, they flagged some headwinds when it comes to their Clover business. They said those headwinds would be mostly in Q2. They expected to recover in Q3. So is the idea here that the headwinds are kind of been resolved and going forward, you see just more upside, or is this a longer-term play?
The headwinds have been fully discounted in the stock price. We think that they might have been a little bit too optimistic. So we think they still might have some issues in this current quarter, but we think by the fourth quarter, they'll be looking a lot better. And at that point, the stock will be a lot higher. So you've got to buy into some of that short-term uncertainty. We think longer term, Clover is a good business, and we think longer term, their earnings can grow in high single digits, low double digits, and you're getting it at a really good price.